Hi, this is Taylor Nissi from Pleasant Street Wealth Advisors, here with the February 24 market wrap. Equities rallied across the board in February as the NASDAQ led the way with a 6.2% gain. Both the Russell 2000 and the Russell 1000 posted gains of around 5.5%, and the S&P 500 advanced 5.3%. The Dow Jones Industrial Average was the relative laggard, but still rose 2.5%, and the tech-heavy NASDAQ still ruled the roost on both the February and trailing 12-month charts. Heading into the year, many economists and investors, our team included, viewed small and mid-cap stocks as an attractive way to play the rate cut cycle. While the rate cuts have not begun, small caps did have a nice rally in February, something that we're going to keep an eye on for the next few months. As we continue to look under the hood of the February's rally, small cap growth led the way with an 8.8% return, followed by large cap growth. Both small and large cap value trailed, adding 3.6 and 3.3%. When we expand our view to the trailing 12 months shown on the right, the large cap growth has been the best performer by a wide margin. At the sector level, we're seeing some healthy market indicators. Industrials were the second best performing sector, adding 7.2% in February, and materials added an impressive 6.5%, while technology and communication services increased 4.7% and 4.6% respectively. This is a nice broadening out trade away from the Magnificent Seven and technology as a whole, and it's a very positive sign that the capital market growth can be resilient. However, as we look at the 12-month shown on the right, there is still a significant gap between tech and the rest of the market. This is a gap that we do hope to see close with the rest of the market catching up throughout the rest of the year. Let's take a look at the fixed income markets. The U.S. Treasuries rose across the board in February, even as equities rallied. Intermediate duration instruments posted the largest increases, highlighted with this yellow box. The 2-year, 3-year, and 5-year all increased by 35 basis points or more. Bond ETFs largely mimicked their January performance in February. The short-term 1 to 3 month T-bill and the iShares High Yield Corporate Bond ETF both inched higher, while the long-term bonds, measured by the iShares 20-plus year Treasury Bond ETF, fell 2.3% for the second straight month. Moving on to the economic data, the U.S. inflation rate for January increased slightly to start the year to 3.09%. Inflation has hovered in the 3% range since July, though it was just logged its lowest year-over-year level since then. Core inflation decreased slightly to 3.86% in January, nonetheless logging its 10th consecutive monthly decline. The U.S. Consumer Price Index rose 0.3% in January, and the monthly U.S. personal spending inched up 0.2%. The Federal Reserve held its key Fed funds rate at 5.5% at its January 31st meeting, marking the Fed's fourth consecutive meeting in which rates were left unchanged. Furthermore, Jerome Powell released comments and testifying before Congress saying that they were likely going to leave rates higher for longer and that they weren't in a rush to cut rates. We introduced our hard landing versus soft landing scoreboard to you all last year. As a quick refresher, our team tracks 6 key indicators to help us quantify the health and strength of the economy and try to identify if we're headed towards a hard or a soft landing. In February, we started to see some signs of slowing growth, but at this time, the majority of the indicators continue to suggest a soft landing. Of the big 3 monthly economic reports, only the ISM manufacturing PMI is flashing a hard landing, and that's by a very slim margin. If we had a print over 50, it would have indicated a soft landing, so 49.1% is getting close to where we want to see it. Retail sales, which is the most comprehensive measure of consumer spending each month, declined more than expected in January and caught some analysts by surprise as the official data is starting to match anecdotal commentary from consumer companies about consumers pulling back on spending. Additionally, credit metrics such as delinquency rates for credit cards and auto loans have risen considerably in the past several months. However, at this point, that's not enough to imply that we're seeing a potentially significant slowing of consumer spending, and for now, consumer spending remains resilient and simply is not indicative of an economy that's about to meaningfully slow. Business spending measured by new orders for non-defense capital goods ex-aircraft remains strong, indicating while there is some corporate anxiety about future economic growth, it is not impacting business spending or investment at this point. And finally, the job market remains healthy. So all in all, the data suggests that we have a healthy underlying economy for these capital markets. Since the October lows in 2023, the capital markets have been on a tear, with the S&P 500 breaking the 5,000 mark on February 9th. And many people are asking us, how long can this continue, and are we in a bubble? So let's take a quick look at some historical data trends. The S&P was up in both January and February for the first time since 2019. After the S&P gained in both January and February, as it just did, the following 12 months historically have been higher an amazing 27 out of 28 times. The final 10 months of the year were higher 26 out of 28 times, and returns in both cases outpaced historical average returns in all years. So the early great performance from this market suggests that this market has plenty of room to run. But remember that this rally we're riding started when we hit the October 2023 lows. So we looked back at the data and found 14 other periods in history when stocks were higher in November, December, January, February, and finished the previous calendar year, so in this case 2023, positive. The average return in the year following all of those data points, so that would be the calendar year 2024, historically averaged 21.2%. So while we're not calling for another 20+% return in 2024, the data suggests we should be in for a good number, and the 20% plus would be a very pleasant surprise. Ultimately, our team remains very constructive on capital markets, but we would not be surprised if the market did let off a little steam here. Any sort of bad data or geopolitical crisis could easily lead to a 5 to 10% correction. In the equity markets, we continue to see the benefits of active management and continue to allocate to our trusted managers. In the bond markets, we continue to look for quality issues and are looking to lock in what we believe will be higher rates for long time after, whenever ahead of any possible rate cuts later this year. In the alternative space, we continue to see opportunities in private equity and private capital or private credit for investors looking to amplify income or capital appreciation. If you'd like to discuss any of the information shared today, please get in touch. Thanks a lot for watching and have a wonderful day.